Hello and welcome to Dividend and Conquer, the place where we unravel the complexities of the financial world to maximize your dividends. Today we're going to explore the exciting opportunities 2024 holds for dividend and income investors, thanks to the Federal Reserve's latest announcement. Imagine this. It's the end of 2023, and we're on the brink of new financial prospects. The Federal Reserve, in their final gathering of the year, signaled their plans to lower interest rates not once, not twice, but 3 times in the coming year. This revelation has infused the market with a sense of optimism, lifting stock prices across the board. But here's the real gem. Certain sectors known for their hefty dividends are poised for significant growth. While the broader market has been flourishing, these particular sectors have lagged behind. This lag presents a golden opportunity for savvy investors like us to capitalize on in 2024. Let's explore these lucrative sectors and pinpoint specific companies and funds that are likely to outperform others. Remember, while some investments have had a rough patch recently, history shows they often bounce back stronger when interest rates are cut. First on our radar is the infrastructure sector. Think railways, bridges, and freight transport, the backbone of our economy. These companies usually need substantial loans for maintenance and upgrades. High interest rates have been a thorn in their side, limiting expansion and upgrades. But with the forecasted rate cuts, these firms can borrow more affordably, potentially boosting their profits and, in turn, their dividends. One standout in this realm is Brookfield Infrastructure Partners, with its ticker symbol BIP. This master limited partnership, with its array of infrastructure assets, is already showing signs of recovery. Then there's the Cohen & Steers Infrastructure Fund, UTF, a closed-end fund investing in infrastructure companies. Although its dividend growth hasn't matched BIP's, it remains a high-yielding option. Next, let's shine a light on utilities, another sector that stands to benefit from lower interest rates. Companies in this sector, dealing with pipelines, cell towers, or renewable energy, also rely heavily on borrowing. However, it's crucial to note that these companies' fortunes are intertwined with the commodities they deal in. For instance, natural gas companies are heavily influenced by natural gas prices. So, a dip in commodity prices can overshadow the benefits of lower interest rates. In this space, Enbridge has caught our attention. This natural gas giant has demonstrated resilience and consistent dividend growth, despite market fluctuations. Energy Transfer, ET, and Enterprise Product Partners, EPD, are also noteworthy alternatives. But wait, there's more. Let's not forget about real estate investment trusts, REITs, particularly those focusing on infrastructure like cell towers. Despite modest gains in 2023, the sector is still undervalued. Crown Castle and American Towers, for instance, are trading at substantial discounts and are ripe for recovery. However, office REITs present a high-risk, high-reward scenario, especially with ongoing speculation about a commercial real estate downturn. Switching gears, let's talk about high-risk, high-reward closed-end funds, particularly those holding high-yield corporate debt. PIMCO funds like PDI, PCM, and PTY saw a decline with rising interest rates, but they are poised for a comeback as rates drop. However, it's a critical time for these funds, as their dividend coverage ratios have been wavering. Now let's probe further into each sector to fully grasp the opportunities ahead. Infrastructure, a sector critical to economic growth, stands to gain immensely from the anticipated rate cuts. It's not just about Brookfield Infrastructure Partners and Cohen & Steers Infrastructure Fund. There are others like the Global ex-US Infrastructure Development ETF, PAVE, which provides broad exposure to companies involved in U.S. infrastructure development. These entities are poised to benefit from increased infrastructure spending and lower borrowing costs. By investing in this sector, you're not just betting on individual companies, you're investing in the backbone of the economy. Utilities, often considered a safe haven, are entering an exciting phase. Beyond Enbridge Energy Transfer and Enterprise Product Partners, there are gems like NextEra Energy, NEE, and Duke Energy, DUK. These companies are leading the charge in renewable energy and are likely to benefit from the shift towards sustainable energy sources. Investing in utilities is more than just a play on interest rates. It's a step towards a sustainable future. Moving on to REITs, this sector offers a diverse range of investment opportunities. From cell tower REITs like Crown Castle and American Towers, to residential REITs like Avalon Bay Communities, AVB, and Camden Property Trust, CPT, there's a REIT for every investment style. The potential in REITs extends beyond just picking stocks. It's about understanding the underlying real estate market dynamics. But let's not overlook the elephant in the room, the high-risk, high-reward closed-end funds. PIMCO funds are just the tip of the iceberg. There's also the Eaton Vance Limited Duration Income Fund, EVV, and the BlackRock Debt Strategies Fund, DSU, which offer exposure to different segments of the high-yield debt market. While these investments come with higher risk, they also offer the potential for higher returns, especially in a declining interest rate environment. As we pivot to business development companies, BDCs, it's crucial to acknowledge their unique position. BDCs like Ares Capital Corporation, ARCC, and Main Street Capital Corporation, MAIN, have demonstrated resilience and a strong track record of dividend growth. While their growth potential might be moderate compared to other sectors, they offer a blend of income and stability. But what about the broader market trends and historical parallels? History teaches us valuable lessons. Take, for instance, the period following the 2008 financial crisis. The Federal Reserve's policy of reducing interest rates had a significant impact on dividend-paying stocks. Utilities, REITs, and infrastructure funds saw substantial growth during this period. By examining these trends, we can better strategize our investment choices for 2024. Let's also consider the importance of portfolio diversification. It's not just about picking winners, it's about building a resilient portfolio that can withstand market volatility. Diversification across sectors like infrastructure, utilities, REITs, and high-yield funds can provide a balance of growth and income, reducing overall risk. But wait, there's more. In the realm of personal finance, anecdotes can be powerful. Let me share a quick story. A few years ago, I invested in a utility company that was transitioning towards renewable energy. Despite initial skepticism, this move paid off handsomely as the company grew, and so did its dividends. This experience taught me the value of looking beyond the obvious and investing in companies adapting to changing market conditions. Speaking of changing market conditions, let's touch on the potential risks and pitfalls. While lower interest rates generally benefit dividend stocks, external factors like economic downturns, geopolitical tensions, or unexpected market events can impact these investments. Therefore, staying informed and adapting your strategy to changing market conditions is crucial. As we approach the end of this video, let's talk about action steps. Here's what I recommend. Start by reviewing your portfolio. Identify areas where you can capitalize on the anticipated changes in interest rates. Consider diversifying across the sectors we've discussed today, and most importantly, stay informed and adaptable. Before I conclude, I have a question for you. Which sector are you most excited about in 2024 and why? Drop your thoughts in the comments below. 2024 presents a landscape ripe with opportunities for dividend and income investors. Whether it's infrastructure, utilities, REITs, high-yield funds, or BDCs, each sector offers unique prospects. Remember, successful investing is not just about following trends. It's about understanding the market dynamics and making informed decisions. Thank you for joining me on Dividend and Conquer. If you found this video helpful, please like and subscribe for more content on high-yielding investment strategies. Until next time, stay informed and let's conquer the investment world together. Remember, we are not financial advisors, and the content presented in this video is for informational and educational purposes only. Always consult with a licensed financial professional before making any investment decisions.